welcome to the Deep Dive. Today, we are really digging into Darden Restaurants, Inc. You know, the big name behind Olive Garden, LongHorn Steakhouse, a lot of places you probably know. A real powerhouse in casual dining.
Definitely. We're talking billions in sales every year.
Exactly. So you might eat there, but what's really happening behind the curtain, we've got their latest earnings release, analyst reports, stuff from their investor call.
Yeah.
We've waded through it all. And our mission today, basically, to break it down for you, give you the essential takeaways on Darden's performance, their strategy, the important bits, fast.
Yeah, and it's actually quite interesting to see how a company like Darden handles things in, well, a pretty dynamic industry. They're posting strong results, sure, but they're also aiming high for the future. It's quite a foundation they've built. We'll get into the numbers, of course, but maybe more importantly, the strategies behind those numbers and what it all means for them, for the industry, and ultimately for you, whether you're just grabbing dinner or interested in how these big companies operate.
All right, let's unpack this then. Darden just closed out their fiscal year 2025. That ended May 25th. And yeah, the numbers look pretty solid. For the fourth quarter, total sales jumped 10.6% to hit $3.3 billion. And their adjusted profit per share, that surged 12.5% to $2.98, which, importantly, actually beat what analysts were expecting. That's always a good headline, right?
Oh, absolutely. A significant beat. And if you kind of zoom out to the bigger picture, numbers like these really tell a story about effective management, especially in this competitive space. Now, for the full fiscal year 2025, total sales climbed a solid 6.0%. Get this, $12.1 billion. That's the first time they've ever crossed the $12 billion mark.
Wow, $12 billion.
Right. And the full year adjusted earnings per share also grew nicely, up 7.5% to $9.55. So it's not just the strong quarter, it's a strong year building on previous ones.
So, translating that, what does it mean for the actual restaurants we visit? A lot of that seems to hinge on same restaurant sales, yeah?
Exactly.
Yeah.
That's a key metric. It shows growth from existing locations, not just new openings.
And consolidated, Darden saw a 4.6% bump in Q4, 2.0% for the whole year. But the real standouts were Olive Garden, huge brand, right? Up a fantastic 6.9% in Q4.
Yeah.
And LongHorn Steakhouse wasn't far behind at 6.7%. That's outpacing the industry average.
It really is, which naturally leads to the question, how are they doing it? How are existing restaurants growing like that when the overall casual dining sector isn't exactly booming? Well, CEO Rick Cardenas points to their strategy. It's anchored in 4 competitive advantages and, as he puts it, being brilliant with the basics. It sounds simple, but it seems to mean really disciplined execution, focusing on core strengths, and importantly, pricing below inflation.
Pricing below inflation.
Yeah, deliberately. To grab market share, maybe even from fast food customers looking for better value. It's about that perceived value drawing people in.
Makes sense. And they're definitely sharing this success with shareholders, aren't they? They boosted their quarterly dividend by over 7% to $1.50 a share. That's $6 annually. Plus, a new $1 billion share buyback program. They gave back, $215 million just in Q4 through dividends and buybacks. That sounds like management is feeling pretty confident, wouldn't you say?
Oh, absolutely. It's a very clear vote of confidence, and it fits perfectly with their stated long-term goal, which is delivering a consistent 10 to 15% total shareholder return. Their CFO, Raj Vanam, really emphasized this. He said, Darden plays the long game. And he backed it up, pointing to their 30-year track record as a public company. Over any 10-year period in that time, they've hit annualized returns of 10% or more.
Any 10-year period, that's consistency.
Exactly. It's not luck. It reflects, the strength of their model, their ability to generate cash steadily, even when the economy gets bumpy. It really speaks to their stability.
Okay, so that's the big picture financially. Let's get into the specifics of the brands now. This is where it gets interesting, I think. Olive Garden's performance, for instance. They brought back the buy one, take one deal. First time in 5 years, apparently, and it was a huge driver for them. Plus, takeout and delivery, their off-premise sales grew almost 20% year over year. That's a big jump.
It is. And what's really fascinating isn't just that the promo worked, but how they use technology alongside it. They have this Uber direct delivery service nationwide now. During a 1 million free deliveries campaign, which Uber helped pay for, by the way, their weekly deliveries nearly doubled.
Uber helped pay.
Smart. Very smart. And crucially, this drove 40 to 50% incremental sales, meaning these are mostly new or returning customers, not just their regular dine-in crowd-switching channels, often younger guests, higher income too, so it expanded their reach without hurting their core dine-in business.
That's clever.
Avoiding cannibalization. Right. And even the delivery fees themselves gave a small boost, about 0.4% to their average check size in the quarter. Little things add up.
Okay, let's switch over to LongHorn Steakhouse. Their success story seems a bit different, more about relentless quality focus. I read this detail. They have an internal grilling competition called the Steak Master Series, just to make sure the steaks are perfect. That's dedication.
It really is. It sounds a bit extra, but look at the results. They hit an all-time high score for steaks grilled correctly and top marks for guest satisfaction, and it translates to sales. Same restaurant sales up 5.1% for the year, and they crossed $3 billion in total sales for the first time ever.
$3 billion just for LongHorn. Wow. So they're really nailing that brilliant with the basics thing, too.
Precisely. It's clearly a core principle, not just marketing speak. But like you hinted, it's not sunshine and roses across every single brand in the portfolio. The fine dining segment, think higher end, places like Capital Grille, maybe Ruth's Chris, now actually saw same restaurant sales drop. Down 3.3% in Q4, 3.0% for the full year.
Okay, so a bit of a mixed bag there.
A bit. Now, the whole fine dining category is facing headwinds in this economy, that's true. But Darden did mention seeing some sequential improvement in traffic from households earning over $150,000. So maybe the higher earners are starting to come back a little.
Interesting. So it's not just the overall economy hitting fine dining.
Yeah.
Are there other factors at play compared to, say, Olive Garden?
Yeah, good question. It seems more nuanced. So for their casual brands, they're seeing growth across most income levels, except maybe households under 50K, which are still soft. But fine dining has this extra layer. Location matters a lot. Traffic to their suburban fine dining spots is almost back to pre-COVID levels, around 95%.
Okay.
But urban traffic for fine dining, still lagging significantly, only 82% in Q4.
So remote work, less commuting.
That seems to be a big part of it. Changes in downtown business activity are hitting those city center high-end restaurants harder than the ones out in the suburbs. It's a tougher recovery for them.
Got it. That makes sense. So looking at this whole picture, what's Darden doing strategically with his brand lineup? Sounds like active management. They closed, what, 22 underperformers? Including 15 Bahama Breeze locations.
That's right, and they didn't stop there. They're actually exploring strategic alternatives for the entire Bahama Breeze brand.
But you mean
Meaning they might sell it off, or maybe convert some locations to their other stronger brands? It shows they're willing to make tough calls, prune the portfolio to focus resources.
So not just cutting, but redirecting resources.
Exactly. And part of that redirection is international growth, but using a franchise model, which is less capital intensive for Darden. Like in Canada, they sold their 8 company-owned Olive Gardens to a franchisee who's now planning to open 30 more.
30 more in Canada. Okay.
Yeah. And new deals for 40 Olive Gardens each in India and Spain, even some Capital Grilles planned for Asia. Plus, acquiring Ruth's Chris last year brought in a big chunk of existing franchise locations and the infrastructure to support even more franchise growth globally. It's about smart, capital-light expansion. Makes sense. And there was also a big leadership change announced, right, at Olive Garden.
Yes, quite significant. Dan Kiernan, who's been president of Olive Garden for a long time, 33 years with Darden overall, is retiring.
Wow, 33 years.
Incredible tenure. And John Wilkerson, currently president of Cheddar's Scratch Kitchen, is stepping into that massive role at Olive Garden. And that sets off a chain reaction. Mark Cooper moves to lead Cheddar's, Lori Kassler takes over Seasons 52, Thomas Hall moves from LongHorn to Ches.
So it really shows they have a deep bench of internal talent ready to step up. Planned succession.
Very much so. It speaks volumes about their leadership development. They're not just filling slots, they're strategically placing experienced leaders.
Okay, so that brings us to the future. Let's look ahead to fiscal year 2026.
Right.
What are they telling investors to expect?
They're projecting total sales growth between 7 and 8%, although about 2% of that is just because they have an extra week in the fiscal year, right? A 53rd week. That's correct. That 53rd week adds a bit of noise. Beyond that, they're guiding for a same restaurant sales growth of 2 to 3.5%, and they plan to keep opening new restaurants, about 60 to 65 net new openings planned. So yes, continued expansion is definitely on the menu.
And what about costs? Inflation is still a thing?
It is, and they're being upfront about it. They expect overall inflation for them to be between 2.5 and 3.0%. Commodities may be around 2.5%, but labor costs are expected to be higher, around 3.5%.
Oh, okay.
But even with those cost pressures, their earnings per share guidance looks pretty healthy, $10.50 to $10.70 for the year. About 20 cents of that is from the extra week, mind you. And crucially, listen to this. Their planned menu price increase for fiscal 26 is only in the mid 2% range.
So below their expected inflation rate again.
Exactly. It reinforces that long-term strategy. Prioritize keeping value strong for the customer, maintain traffic, even if it means margins aren't quite as high in the short term.
Right. It really sounds like they're committed to this disciplined growth, even if they need to invest strategically. They updated their whole long-term financial framework, too, still targeting that 10–15% total shareholder return.
Right.
But they actually increased their target for new restaurant growth, now aiming for 3–4% annually, and refined the same restaurant sales target slightly to 1.5–3.5%. They're not shying away from growth targets.
Not at all. And that updated framework, it includes an interesting shift in how they talk about measuring success or profitability. They've moved away from focusing on EBIT margin expansion, that's earnings before interest and taxes, basically core operating profit.
Okay.
Now they're targeting EBIT margin expansion, earnings after tax, aiming for just 0 to 20 basis points of expansion there.
BT. So that includes interest, taxes, everything else.
Pretty much. Things like how stock options are expensed, lease accounting rules, impacts from acquisitions like Ruth's Chris. It's a broader, more, well, holistic view, as they put it. It reflects that long game idea again. They're signaling that maybe restaurant-level profit margins won't grow as fast because they plan to reinvest more aggressively.
Reinvesting where?
Potentially in things that drive that sustainable growth, maybe holding prices lower, investing more in labor for better service, marketing.
Okay. So they're willing to accept slightly lower operating margins today to build a stronger business for tomorrow.
That seems to be the message. It shows a certain confidence, doesn't it? Prioritizing the long-term health and growth over just maximizing margins quarter by quarter.
Yeah, it does. They're projecting marketing spend to grow faster than sales, which fits that idea. Continued investment in affordability, service, keeping the guest experience front and center.
It seems like a strategy built on the belief that keeping customers happy and providing value will ultimately drive the best long-term returns.
So wrapping this up, we've gone through Darden's pretty strong Q4 and full-year results for fiscal 2025. We've looked at the strategies making Olive Garden and LongHorn shine, and we've peeked into their plans for fiscal 2026 and their updated long-term view. The themes seem clear: disciplined growth, smart portfolio management, including those tough calls like with Bahama Breeze, and always keeping shareholder value in mind.
Absolutely. I mean, Darden's ability to keep offering value even with costs rising and to make smart bets on things like delivery and franchising while actively tweaking their brand mix, it really is a fascinating case study. That play long game mantra, backed by decades of results, it just seems to work for them. It's operational skill meeting strategic patience.
So what's the final takeaway for you listening in? Well, as a customer, expect continued focus on value and convenience from the big players like Olive Garden and LongHorn. They'll keep trying new ways to get you in the door or deliver to your door. And if you're interested in business, it really prompts some thought, doesn't it? In this constantly changing economic climate with shifting diner habits, how do companies like Darden keep adapting? How do they manage that tricky balance between consistency, that perfect steak every time, and innovation, while also navigating these different spending patterns between income groups and the whole urban versus suburban challenge? Definitely something to chew on until our next deep dive.